Here's a number that should stop you mid-scroll. The typical American home now costs north of $429,000. 20 years ago, that bought you two houses with change left over. So the real question isn't what's the market doing. It's where do you actually fit? A $150,000 home, a $300,000 home, a $450,000 home, and a $900,000 home are four completely different financial lives, and most people have no idea which one they're standing in. Over the next few minutes, you'll find out exactly what income, what down payment, and what kind of life unlocks each tier, and who's really buying at the top. First, the backdrop. The Federal Reserve has held its benchmark rate steady this year, sitting in the mid 3% range. After a run of hikes aimed at inflation that's still running above target. That's kept the average 30-year mortgage rate parked around 6.5%. Home sales have picked up a little this spring, but prices haven't budged much. The typical existing home is selling in the high $420,000. The Midwest and South are still relatively affordable. The coasts are not. And even with rates a touch lower than they were a year ago, the math you're about to hear still stings, because wages have not caught up with what homes now cost. Inflation is still running well above the Fed's target, which is exactly why the central bank hasn't cut rates further, and why most forecasters expect mortgage rates to stay parked in this range rather than drop back toward the lows people got used to a few years ago. So if you're waiting for relief, you may be waiting a while. Let's start small. A $150,000 home in 2026 sounds like a typo, but it's real. Just not where most people are scrolling on Zillow. You'll find it in small-town Ohio, rural Kansas, parts of West Virginia, the Mississippi Delta, and dozens of Rust Belt towns that never fully recovered their population. Put 20% down, and you need $30,000 in savings, plus a few thousand more for closing costs. Your loan is $120,000. At today's rate, that's roughly $760 a month in principal and interest. Call it $950 once you add taxes and insurance. A single person earning around $45,000 a year can carry that comfortably, even after a lender stress tests the loan. The catch is the same as it's always been. You're buying into a town, not a city, and that trade-off shapes your job options, your social life, and how fast that house actually appreciates. But there's a quiet upside. Paying off a $120,000 loan in your early 30s frees up cash most city dwellers won't see until they're pushing 50. That extra room becomes the seed money for everything that comes next. It's also worth saying plainly, these towns aren't guaranteed to appreciate the way a growing metro will, so you're trading speed of ownership for patience on growth. Now double it. A $300,000 home puts you somewhere completely different. Outer ring suburbs of cities like Indianapolis, Columbus, San Antonio, and Jacksonville, or smaller metros across the Southeast that haven't caught fire yet. 20% down means $60,000 in cash plus closing costs on a $240,000 loan that runs about $1,500 a month before taxes and insurance, closer to $1,900 once you add those in. To clear a lender's stress tests, you're looking at household income somewhere around $80,000 to $90,000 a year. One person on a strong salary can stretch into this tier, but it's a lot more comfortable with two incomes. This is also where first-time buyer programs earn their keep. An FHA loan can drop your down payment to as little as 3.5%, which turns that $60,000 hurdle into roughly $10,500. The trade-off is the same one it's always been. A smaller down payment means a bigger loan, more interest over 30 years, and mortgage insurance tacked onto your monthly bill until you build enough equity to drop it. Worth noting too, property taxes swing wildly by state, so the same $300,000 house can cost you a few $100s more or less a month depending on whether you're buying in Texas or Tennessee. Before we go any further, drop your number in the comments. Which tier are you actually in right now? And which one are you saving toward? I read every one of these and it tells me exactly what to break down next. Now we hit the one that matters most. $450,000. This is the median American home in 2026. The one your parents may have bought for under $150,000, and you're now expected to afford on an ordinary paycheck. It buys a standard family home in places like suburban Atlanta, Phoenix, Charlotte, parts of Denver, and plenty of mid-sized metros in between. 20% down is $90,000, plus another $10,000 to $15,000 in closing costs. The $360,000 loan runs close to $2,300 a month in principal and interest, and around $2,800 once taxes and insurance are factored in. A lender will want to see household income in the neighborhood of $120,000 to $130,000 a year, well above what the typical American household actually brings home, which sits closer to $80,000. That gap is the whole story. It's why two working professionals can still feel stretched thin, even with good jobs, and why a mortgage payment eating up a third or more of take home pay has quietly become normal instead of alarming. There's a generational split hiding in this number too. Anyone who bought before the run up of the early 2020s is sitting on equity most renters can't imagine, and a lot of that equity is now funding their kids' down payments. Meanwhile, the buyers arriving fresh to this tier are doing it later in life than their parents did, often in their mid to late 30s instead of their 20s, simply because it takes that much longer to save the down payment and qualify for the loan. Finally, the top tier, $900,000 and up. This is coastal California, the New York Metro, Greater Boston, Seattle, and the most desirable pockets of Denver and Austin. 20% down is $180,000 plus $25,000 to $30,000 in closing costs, depending on the state. The $720,000 loan costs around $4,550 a month before taxes and insurance. Push past $5,700 once you add those, plus an HOA fee in a lot of these neighborhoods. Lenders typically want to see household income north of $250,000 a year. And here's a detail most buyers don't see coming until their lender mentions it. Once your loan crosses roughly $806,000, you're no longer in conventional loan territory. You've stepped into a jumbo loan, which usually means a larger down payment, tighter underwriting, and sometimes a slightly higher rate than the headline number everyone quotes. So who's actually buying these homes? Rarely is it two people on regular salaries. It's business owners, senior executives, tech employees with equity compensation, doctors and attorneys, people trading up using gains from a home they bought a decade ago, parents quietly covering a down payment for their adult kids, and a growing slice of buyers who've built a second income stream outside their job through investing, a side business, or assets that pay them whether or not they clock in that day. That last group is worth paying attention to because they're not earning their way into these homes, they're owning their way in. A paycheck gets taxed the second it lands. Assets, index funds, rental property, a small business, dividend-paying stock, quietly compound in the background for years, often inside accounts built specifically to grow, without the IRS taking a cut at every step. Your salary buys you a house in a small town. Two salaries get you into a suburb with some breathing room, but ownership is what actually moves the needle while everyone else is debating whether the Fed cuts or holds at the next meeting. None of this means a paycheck doesn't matter. It does. And it's still the foundation everything else gets built on. It just means a paycheck alone with nothing else working alongside it is no longer enough to climb the ladder the way it used to be. So if you take one thing from this video, make it this. The fastest way into a better home isn't a bigger paycheck. It's building something you own. Open a Roth IRA and put $50 a week into it. Start the side project you've been putting off. Or just sit down tonight and map out one income stream that doesn't depend on your employer. Because in a country where the median home now costs more than 5 times the median income, relying on salary alone is a losing strategy. And figuring that out earlier than most people do is exactly what this channel is here for. So if that shifted how you think about your own number, subscribe and stick around, because next week we're breaking down exactly how much you'd need to retire in every state.